me start by saying thank you so much for the nice things Marshall and others have had to say about the work we are doing at Rhodium and the work we've done together with Asia Society. I have a number of my colleagues here this morning without whom this kind of stuff doesn't happen. And of course, it doesn't happen without a partner like Asia Society to help us reach a broader audience for what we think is very important analysis of what's going on in China today. Change is, I think, the key word that has been used here at the podium so far the most this morning. Change is difficult. Change can be very dangerous, in fact, when you switch out something that's been working for a long time for something new. And yet, as Jack said, he lived through and was a firsthand witness, as many of you are in this room, to a period of extraordinary change in China, in the most populous nation on the planet, through the 1980s, through the 1990s. In 1992, after the period of greatest risk in China in 1989, to where they thought they needed to head, Deng Xiaoping decided it was time to get back out on the campaign trail, so to speak, and help people understand which way China was going to go forward from that point. There were quite a few folks who thought that marketization had brought about the tumult and risks of 1989. Deng put an end to that chapter of debate by saying with extraordinary clarity that if China did not get back on the path of reform and opening up to the world, it would quickly find itself in a silu yitiao, a blind alley, a dead end, a cul-de-sac from which it would not be able to proceed forward into the future. Neither the party nor China as a state would be able to progress. He thereafter began a process of opening, liberalizing, marketizing China's economy through the 1990s that paid dividends. Many of those dividends didn't show up as these things happen for some years to come. Some of them did in the 90s. Many of them didn't arise until the 2000s. It's often the folks who come in after a change agent does her hard work or his hard work who harvest the greatest dividends and returns from a process of change. This slide here, and almost all these slides are in the report, the 191-page report, indeed a heavy lift, describes some of the extraordinary performance China enjoyed from 2000 to 2012, largely as a result of reforms and changes that had been made in the years prior to this, culminating in China's 2001 WTO accession, of course, which was sort of a signature and symbol of how ready China was to run its economy in a very different way. Just to point out a few of the things that occurred over this time period. I don't know if this laser pointer is going to work from this angle, but that second set of bars there, China, 20% of the world's population, a tripling of its GDP share in the world in a little over a decade, from 3.7% of global GDP to 11.4%. In terms of trade flows, China dramatically globalizing. This was globalization 1.0 for China, deeply integrating itself into global production networks and trade flows, up to about the same share as its GDP weight in the world. Moving over to the bars more on my side, we see where China has yet to go. Full financial globalization. Quite a bit already done in terms of direct investment flows, both into China and out, merger and acquisition and greenfield investments in facilities around the world. But in terms of the financial potential for China's participation in global stock and bond cross-border flows, we're starting from virtually zero. And as Jack is as aware, more so than most people I know, the amount of deal activity, the amount of benefit and welfare for savers and investors that will come with that kind of the changes that are still to come on the financial side are just extraordinary. So this was the dividend of Deng Xiaoping's commitment to get out of a blind alley and to put China on a broad avenue that would take it forward into the future. And it delivered the goods. The growth occurred, the structural adjustment occurred, and as Josette noted, the poverty alleviation and progress in this nation was unheralded in human history indeed. Xi Jinping, China's president and general secretary of the party today, is perhaps the first Chinese leader to come into power since Deng who knew pretty much on day one on the job that during his term, China's growth would break down and that blind alley would be exactly where the country was if he didn't find a way to put a new commitment to reform and opening to the world on the table. That he had a precious short amount of time in which to get this done. There's a few reasons which we discuss in the study. The principal engines that had impelled China forward in the past have all come around from being supportive to being in the way of future progress. Demographic dividends, the sheer movement of hundreds of millions of people from underproductive use in the country to more productive jobs in urban China, has reached the bottom of that smiling little black line in the middle of this chart. Instead of the dependency ratio, the number of people working for those who need to be educated and those who are in their senior citizen days, is no longer shrinking, it's now increasing. So that was a big contribution to China's ability to deliver the numbers in the past, and now it's gone from being supportive to being somewhat of a headwind. Capital stock deepening. At the beginning of China's reform process, almost any investment was going to be productivity enhancing. So much to be done. So little capital had been available to deploy to stoke growth until the 1980s and especially into the 1990s as more modern financial intermediation started to direct funds, that you could invest in almost anything, and get a big boost to GDP from having done it. China has outpaced almost any developing country in history in terms of the share of investment in overall GDP activity. 50% of China's growth coming from investment growth each year at the present moment. That's above what others managed to do for a very long period of time, and it's clear to us now that the marginal return on that investment is shrinking quickly. There are diminishing marginal returns from the investments that are being made in China today. Investing in another steel plant is not going to generate a very good internal rate of return in China when you're already 300 million tons over capacity, and the world can't take much more of what you can roll out of the factory. So capital deepening as a way of pushing growth faster and faster each year is at its turning point, and it's going to play less of a role in the future than it played in the past. The third factor that was so important in China is the one that economists cannot see directly. After you've counted all the people and all the money going into a factory, any growth you can get in terms of the output, we call a residual. We call it total factor productivity. It means you can get more done with the same resources. And that's the holy grail, really, of good economic statecraft and policy making today. How do you do that? You do that by raising the productivity of those resources that are going into the process. You can do that by lifting the technology level, by trading out old technologies for new. You can do it by shifting which industries you're trying to focus your resources in. So instead of overwhelmingly doing farming, you start overwhelmingly doing textiles and apparel and consumer electronics assembly. And just by shifting that industrial mix around, you can add significantly to GDP potential in a country. That requires, increasingly as a country becomes wealthier, good institutions of government and governance to help ensure that those participating in the allocation of those resources in the marketplace and the individuals like us that need to make a choice for ourselves and for our children, what industry should you go into? What education should you have? That all requires good information, a good education, and a good environment in which to put those tools to work. China has had extraordinary gains from those productivity channels of growth in the past. As there is an urgent amount of debate today, that total factor productivity boost to growth is diminishing very, very quickly. And the reason is that as a country becomes wealthier, the goalposts for what is good governance and good regulation of an economy have to move as well. And most Chinese economists are arguing today that the previous decade did not see governance and regulatory reform come along fast enough to keep up with the needs of a rapidly urbanizing, increasingly middle-class, higher-income Chinese economy. So this is the legacy of the past decade that Xi Jinping inherited, very different than the legacy which his predecessors had encountered when they took the keys to Zhongnanhai, when they came into the job. This chart's a little complicated, but it shows you the breakdown of capital, labor, and total factor productivity in adding up to the growth performance China was able to deliver over the past 2 decades of its reform. Note going forward that labor force growth is 0. We're no longer in a position to grow China by just adding more to the labor pool of the country. It's going to be these other channels. How much more capital stock deepening can we do? How much more productivity potential is there in the economy? Those are the questions we need to address to give ourselves confidence about what China's potential in 2020 is, which is the urgent question which strategic decision-making, both in business and in government and in civil society for that matter, all have to address. We put those numbers together, and these are the 3 scenarios that we can envision in this report. The top line, the dotted blue line there on top, shows what China can achieve if it's capable of implementing the extraordinarily broad set of reforms that were laid out in last November's third plenum 60 decisions. 3% additional growth from capital and 3% additional growth from productivity enhancements in the economy, for a total of 6%. 6% GDP growth in 2020. That's about as good a news story, I think, as anybody should expect for a country that will by then be $14.4 trillion in GDP value in current terms if China is able to stay the course, keep productivity going in the right direction. The lines below that blue line in green, and I think that's supposed to be red originally. Is it black? I can't tell from here. Give us a sense of what failure to implement reform would necessarily mean. If you take away the total factor productivity gains that are possible, you wind up where the Conference Board wound up this week, thinking that something like 3.5% GDP in 2020 is all you can muster just by building more bridges and more highways and more, I dare say, steel plants as well. The line below that is what happens if capital flight starts to occur because people are so anxious about the lack of governance and regulatory reform that instead of finding ways to put their money to work in China, they start worrying about ways to put it to work someplace else, or at least just keep it in the mattress, rather than putting it at risk in capital markets which are not being adequately reformed. The numbers add up to massive losses to total global growth potential in 2020, and this you'll find in the report as well, if China finds this crisis course or a hard landing course instead of reaching its potential. So this is not just important to China. This is important to all of us. We're all party to China's success or failure, hopefully to their success. That brings us to the third plenum. Even today, there's quite a bit of doubt, mystery, and uncertainty about what China's set out to do and whether it's doing it. The bulk of the study dissects it, takes it apart, and tries to understand what's intended here and how well is it coming along. The first thing of note is that in Decision 3 of last year's 60 decisions, there's an entirely new mission state for government laid out. President Xi is unambiguous in stating that much of what China's government has been doing to date is no longer appropriate to the country's needs, if in fact it was ever appropriate. Having bureaucrats get in the way of the flow of resources in competitive industries, adding very little value in the process of doing that, has to stop. The market must decide which strong companies survive and grow and attract resources and people, and which die and fall out of the marketplace so that the capital they're taking up can be redeployed into sunrise industries and sunrise firms that have a better ability to service the needs of an increasingly market economy. There are many things people often have started asking in response to this study. Isn't Beijing pulling back so much power to itself? Isn't there a centralization of power here taking place? And isn't that antithetical to modernization and marketization? And I would say, to a great extent, no. There are many things which only the central government of China can do and must urgently do in terms of protecting the potential and the welfare of the nation. Environmental protection, provision of public services, including health care and education, assuring a judicial system in which firms can expect a fair hearing for their claims against one another. Market economies go to court constantly. They do so more than anybody does. You need a system to adjudicate that if you expect to have healthy, efficient outcomes in the marketplace. So the leadership showed that it understood what China had to stop doing at the top level and what it needed to start doing quite urgently. In the adjustment between the way things were, what government did, and what it must do, there's going to be a lot of confusion about what's going on, why so much power seems to be taken to the center, in what ways power is being pushed out of the center for provincial and local administration. We're all going to be scratching our heads unless we have a sense of what the big tectonic plate trend and shift is here. We go deeper, and this is the most daunting slide you'll encounter here from me in the next 3 minutes, so don't be too intimidated. We're not going to stay on it too long. But when we take it apart and put the whole of 340 or more commitments back together again in a way that makes sense to us, we see that it's not such a mysterious document, this 60 decisions. It actually breaks down into 9 regulatory functions that are precisely those that are on the short list you'd get from the IMF or from any other kind of stalwart of establishment, market, advanced economy thinking about what you need to do to regulate an economy. We'll circle back to this on the panel, I hope, but we look at the design of what China has laid out for itself to do, and it's highly concordant with and convergent with what we think the right approach to policy work in each of these areas, center-local fiscal reform to domestic financial system reform to border trade and financial liberalization, land reform, labor and welfare reforms, and many others as well. We find over the past 11 months implementation starting to move forward to an extent greater than the vast majority of analysts expected to be possible just 11 months ago. They didn't think it was possible because they didn't think China had a strong enough leader or a system that could push past all the vested interests that were opposed to change because it's dangerous, because it's daunting, and because it takes away from the money they're already making. It's awfully tough to take money away from people, especially in a system like China's. Xi Jinping has shown himself capable and intent on doing that. So we find a lot more work moving forward on these things than most people expected to be the case. What are the consequences for us in whether this succeeds or fails? We look at it through 2 channels, principally, through trade flows and through financial flows. We start with our thinking about how big a GDP, a gross domestic product, China would have in 2020 by reforming. And then we ask how much trade flows off an economy that size, how much finance flows in and out off an economy that size. And we come up with these projections to help people think about the magnitude of what we're talking about. From the first 3 bars, which are 2013, exports, imports, and the trade balance respectively, we see in our baseline, and note it's our baseline, because our best guess here is that China will implement this reform program. Exports and imports both go up very dramatically, as they must. Imports goes up much more than exports does because that's where the bulk of liberalization remains to be done. So much so, in fact, that on $3.7 trillion of Chinese imports in 2020, China for the first time is starting to run modest trade deficits with the world, as it should as a more advanced economy, and in fact, as it's comfortable and prepared to do, I believe, in the medium term. In a hard landing or a crisis scenario, China's readiness to liberalize to imports comes off the table. There's a lot more parochial and protectionist thinking about how to maintain China's growth. And instead of a modest trade deficit, we get very big trade surpluses, as bad as those we saw in the late 2000s that gave rise to so many global concerns about where China was headed. This just shows the pattern of those trade flows in the years to come and where we've been coming from. So we don't want to get back to that really big bulge in the trade balance from the 2000s. We want to get where we are in the baseline here to something like a balance or a modest trade deficit in the years ahead. On the financial side, note the first slide I looked at, I told you even bigger effects there because we're starting without having done as much as we've done on the trade side. So this is stated in terms of China's assets and liabilities with the world. A Chinese asset means holding $2 trillion or more in U.S. treasuries. A Chinese asset means owning Smithfield Ham. A Chinese asset might mean a stake in a new canal somewhere around the world. A Chinese liability is GM Shanghai, that there are foreign firms in China that have a claim on assets in China. Or it means Fidelity being able to use its QFII, its Qualified Foreign Institutional Investor License, to buy A shares directly. So there are assets and liabilities on China's balance sheet today. China has a modest net foreign asset surplus position. We take that forward to 2020 with our assumptions about financial liberalization, and we find extraordinary growth in two-way cross-border flows of investment that build up a much bigger asset and liability position. In fact, over $10 trillion in additional deal activity, financial flow activity in and out of China in that time frame. I want to direct your attention almost finally, to the hard landing and crisis here in the financial flows. Note that in almost any scenario, there's going to be a lot of capital flowing out of China as it builds up its savings, and then rationalizes it. The big question mark here is the world going to continue to be able to and to want to invest into China, whether they're going to buy Wadsworth's pitch and want to have that 5 to 15% exposure to the China story. That depends on if China's growing. If it's not growing, then there's much less interest in being exposed to it. And this massive Chinese external surplus in assets is going to be described as capital flight, not a healthy diversification of China's vast savings portfolio. This is what the numbers look like when we break it down by different classes of financial flow. We can circle back to that and talk about it a little more on the panel. Last slide. Conclusions and recommendations. We draw as many as we can from the analysis, although, as Josette said, the principal objective here is to provide a more objective assessment of what's happening so that policymakers and business leaders can draw some of their own conclusions about how important it is to weight a success scenario for where China is going, make sure we're responding adequately to the opportunities and challenges that will arise from that. Nonetheless, we need to bear in mind this is a game-changing reform process taking place. I regret to say that I think many folks, even in U.S. government, are still sitting on the fence and assuming it's too soon to tell. Each year wasted in responding to what's happening in China right now is going to be increasingly hard to make up for with a strong competitive response to the changes taking place in China today. Convergent, more or less, with how we think an advanced economy should be run. There'll be plenty of exceptions, even if China is an advanced economy. Let's remember, advanced economies include Mexico, they include Italy, they include lots that are not just like the United States, and there's going to be differences of view in how our relationship works, even if they, by far, make the standard of an advanced economy. Their start has been faster, and they're using transparency in terms of what's happening in their economy as a key tool to make sure that they progress with this. Don't wait until 2020 to implement it all, but get enough done each year between now and then that this thing can happen on schedule. A prospect for political adjustment. As we're sitting here today, China's fourth plenum is taking place, which is centered on rule of law or by law or according to law or whatever that's going to mean. But there is a recognition in China that all this good regulatory reform work that we describe in the study cannot be enforced and put to work in an even-handed and due process-driven manner without a considerable change to the way politics works in China, not just new thinking about regulatory change. Recommendations: this is not the end of this effort. We need to be gauging how quickly they're moving, where the shortfalls are occurring in their implementation of this reform on a quarterly basis going forward to have greater confidence in our own policy response to what's happening. We need to be supportive of this reform. This is about as good a basket of reforms as we could expect to be coming out of China today. We need a domestic response. With this shift in Chinese gears in terms of what they're doing, our China policy now starts all the more at home. Our China policy flows from how competitive we are, from how well we retool our economy to be responsive to the changes taking place in China today. This is inherently going to be a multilateral story. Everyone is going to be responding to what's happening in China at the same time. There's no reason why we shouldn't be thinking about this, not just on a bilateral basis, in fact, but as a set of advanced economies especially together. And finally, whatever we thought we had to force China to do, push China to do, twist arms to get them to do a few years ago is very different than the set of things that they're still resisting today. China has decided that it is in its own interest to go almost whole hog toward the set of policy innovations and regulatory reforms that most of us in this room would agree are the right mix. We now have to rethink what's on our short list for negotiations and make sure that we're asking for things that are still on the uncertain list, not things that have already been signed off for implementation. With that, let me stop and thank you again for joining us this morning. I look forward to the discussion.